Hello and welcome to the weekly RentFax user training webinar. We do appreciate you taking your time today to join us. We believe it'll definitely be a benefit to you. Today we have our co-founder, Shane Sauer, here to help us and educate us in regards to RentFax. And without any further ado, Shane, are you there?
Yep, I'm here. Thank you, Stephen. And sorry about the slight delay in getting this started. Just had some technical difficulties, but we're ready to get going, and thank everybody for hanging in there and joining us today. So, Stephen, if you want to pass the screen my way, I'll get things started here.
All right, there you go.
All right, so today, really the topic and what we're going to hit on is a couple of case studies of how RentFax has been used by different businesses and entities to use it within their operational decision making and how they conduct business, and how we RentFax and the products have played a role in that. So first, just a real quick recap on the product itself. RentFax offers a host of products through reports. One of those being our hallmark or signature product is the risk index, and that is a proprietary tool and scoring system to quantify the risk associated with a geographic location based on its ability to produce a steady and consistent rental income stream. So the RISC is an acronym for Rental Income Stability Composite Index. So it's the risk index. Another product we have is our Rent Radar. It's a compilation of a lot of rental data where we are trying to really drill down and provide a very accurate assessment of what a subject property will rent for. And we're putting that into an analytical model that just doesn't give a number but gives a probability of such. And then our final product suite focuses around pro formas and income generation. Today, though, we're going to focus on how the risk index played a part and the Rent Radar played a part in some business decisions of different people. So what is the risk index? I talked about it a little bit, but it's a compilation of factors that impact rental property income, from crime and housing and schools and a bunch of different jobs, and I mean, you name it. It's just all this data and information that we've aggregated and studied and developed these relationships between how properties perform, rental properties perform versus the demographic and associated data with that neighborhood. So it's a single score that takes all that information and rolls it up into a single thing. It's kind of like a credit score, if you will. Credit score is looking at payment history, other credit parameters, and everything else, but it's rolling up into a single score associated with a borrower or a person. We're much the same. We're taking a bunch of different information and data, rolling it up into a single score that is put on a scale from 0 to 100, with 0 being very low stability or no stability within rental income, and the upper end of 100 being absolutely, extremely stable rental income. So, and why that's important as a investor or lender, or however you may touch investment properties, that stability is really a good indicator of risk and some decisions you should make. So single score from 0 to 100, 0 being not stable at all, 100 being very stable. What does it mean to investors? We talk about attributes of security issues, crime against the property. So I'll just use one of these, a crime against the property, that if you have a low score, those areas, neighborhoods have exhibit a greater likelihood to have crime against the property. So vandalism or theft. So if your properties or locations are scoring down here, there's a higher likelihood that we have that data would show that you're more susceptible to a crime or vandalism incident. So again, again, you're just seeing that there's all these different relationships, all of them tied to the stability of the income. And so this is why it's so hard and confusing for people to take raw data and apply it to a business decision, because there's just so much information. So again, just take another example here, school quality. So the higher stability rental income locations tend to have higher school quality. So people, when tenants will move in because they like the schools and they tend to stay there and stay in those neighborhoods and want to keep their kids into those better schools. So again, just another example in all these attributes. So the first example that we're going to run through is actually a property insurance company. So it's a national insurance company that insures over 50,000 locations across the country with a specific focus on residential rental property. So what we went in and helped this company with is we received their theft and vandalism claims only. So not weather-related claims, not flooding, not any of that. So nothing weather-related here, but we just got their theft and vandalism claims as it occurred on their insured locations across the country for investment properties. So this is just a map showing all the pins of all these different locations and where these claims occurred. And so again, it was a nationwide sampling across several major MSAs. Here's the results. So again, we talked about our graph here of low stability, no stability down on the zero side to high stability up here. And this graph corresponds to this chart from 0 to 10, 10 to 20, 20 to 30. These are the scores on the chart. And then this is the number or the percent of claims. So you can see here that with this company, the number of theft and vandalism claims, it's over a 2-year period, that almost 35% of them occurred in scores from 10 to 20, down in this range. So you can see as the score, the risk index score improves or increases, the likelihood of a theft or vandalism claim at that location drops, almost in a linear portion here. So again, it's a great example of how the risk index accurately is predicting the likelihood of this insurance claim. Now, if you're a insurance company, I mean, this is a significant benefit, because a lot of their revenue degradation is coming through claim activity, and that's what they're trying to avoid. But if you're a individual investor, knowing this is the difference between having several years of profitable operation and just one theft or vandalism incident, you lose your tenant, you got to make repairs, just bad things are happening, and so you want to avoid or protect against these instances. So in a summary of their results, so for the 2 years from 2010 to 11, almost 70% of all their claims occurred in neighborhoods scoring 30 or less on the risk index. And then we did an additional follow-up study for them in the years 2013 to 2014, and 65% of all the claims occurred again. So pretty similar results, again, 30 or less on this scale here. So right here is 30. 30 and down is where all this high exposure to these claims was occurring. So it's one way that not only a big company, being an insurance company, applied the risk index to make better decisions on how they insured properties, but as an individual investor, you can also go knowingly and educated into those areas that your exposure to theft and vandalism is higher. So it doesn't mean that you don't invest in those areas. There are people that do, but taking additional precautions, taking additional measures is a proactive way that you can hedge against those events. So So I'm going to move on to the second application or case study, and this actually had to do with a private lender. So again, we did a stress test for this lender. They provided us 550 loans. These are all non-recourse rental loans. So what non-recourse rental loans means is that the underwriting and the decision making primarily resides on the asset itself. So what are the lenders? The lenders are focusing on the asset, the income stream from the asset, and everything else. And so it's a good way for us to look at a portfolio that's stressed, just the asset and not the borrower performance, but the asset performance. So it's a multi-market lender, again, residential properties, so single-family home. So the question we ask is, what do these numbers have in common? 19, 19, 24, 24, 24, 32. Well, the answer is those were the scores of the foreclosed properties. So all the foreclosed properties, and we did not know this when we ran this test. They didn't provide us any information on they just kind of said, hey, run these for us, and then it then came back that all their foreclosures had occurred on these scores. So the interesting thing, over the total portfolio, their average risk score was a 42. Pretty good. Looked good when you looked at all the properties. The average foreclosed risk loans was 24. So you can see it a lot lower. So when you look at that, if I was a note buyer and I looked at a portfolio and I averaged it and I said, hey, this looks pretty good, 42, I might say this would be a good portfolio for me to buy the notes. But this next slide really kind of tells the tale. That if we segment that portfolio, we can see here that across the portfolio, they had a 1% default rate, which is pretty good. Let's say that's a real good for asset-based lending, non-recourse lending, have a 1% default, not doing bad at all. But if we segmented that portfolio, kind of like we did with the insurance company. When I say segment, I'm going to go back up to this slide here. This is segmenting, where we're breaking out the number of properties by score. So we're taking this big bucket of 550 loans, we're segmenting it. And so we said, okay, how about if we look at all the properties that scored under 32, the default rate for those loans is 7%. So that would be astronomically high. It would be extremely difficult if you were a lender or a note buyer to successfully operate in a default rate at that high. But when we look at the default rate for properties over it, none. No properties over 32 had defaulted or gone into foreclosure at that point. So segmenting that portfolio really tell the tale. If I look at it as a portfolio, again, only 1% of the total portfolio, so that looked good. But a deeper dive in using the risk index by this lender, they now know that their exposure to default for property scoring under 32 is so much higher. So now they can make adjustments in how they approach properties, how they approach locations, and maybe they're adjusting what they do loans on, what they don't do loans on, how much they'll lend in specific locations. So another example of how it's not a yes or no, it's not a go or no go. What it is it's providing an educated decision of which you can adjust your business practices. So this is a example now for how a lender and note buyers can use it. So now we move into well, this is kind of the summary of that the lender's higher risk scores, lower, the higher the risk score, it is really the lower risk of default. And then a note to, like anybody participating in note buyers or banks buying notes, if they can segment that portfolio by risk, they're going to get a much more accurate prediction of the performance and what can or can't happen. So moving on to our next challenge, now we're going to bring it down to the investor level, or bring it up to the investor level, however you want to look at it. And this is just this particular example is an investor who wants to invest locally in his own MSA. And so a lot of people say, look, Shane, I know my own backyard. I don't need tools or anything to really help me. Well, we always challenge that because you know your backyard through the perception and bias of what you know or think. What we're doing is we're presenting your backyard without that bias. We're presenting raw data that's updated almost on a monthly basis that is taking into account maybe a lot of factors that you're not in tune with. So unless you have time to research crime and unemployment and income and all that stuff all the time on all the neighborhoods in your MSA, I would suggest that you should reach out and use a affordable value-based tool like us that is doing all that for you. So in this particular example, they're looking at 2 properties to consider. So the first property, subject A, 4-bedroom, 2-bath, 1,200 square feet. It was selling for $55,000, rented for $850. Had a gross rent multiplier, which is just a ratio between the sales price and the annual gross rent revenue was 5.39. The second property, subject B, both these in Kansas City, 3-bedroom, 2-bath, $1,250. Price was $67, rent $850, gross rent multiplier 6.62. Okay, so let's look at the 2 side by side. When you look at these side by side, you're gonna the more favorable property is subject A. You're paying a lower price, you're getting about the same square footage, you're in a ranch versus what appears to be a split entry or split level, you're getting the same rent. So if I'm an investor and I'm just using these financial metrics, I'm going to purchase subject property A. Okay. Now let's take a look if we take into account risk, the risk associated with the future successful operation of this property as a rental property. Subject A scored a 19. Subject B scores a 41. So here's where subject A is, and it's census tract, and here's the census tract that it captures subject B. Does your opinion as an investor change, knowing that subject A exhibits high risk attributes for the long-term successful operation and realization of that income stream versus subject B that has a 41 that shows a much higher stability in the likelihood of you achieving what you think? So the reality is on the gross level, while this subject A appears to be a better investment, when you take into account the risk associated with it and the likelihood that you will realize that income stream, that's the missing component. And that's really what we're highlighting here. It's not to say that you shouldn't go with subject A or subject B, but as an investor, aren't you making a much more informed decision at this point? So as a great next step, if I was this investor, maybe I would take each of these properties to my property manager. Assuming I have a property manager that I've vetted, they're familiar with the market, they have a lot of experience, and take each of these to them and tell them, and just ask them and just say, hey, I'm concerned with dealing with potential issues of this subject property A, such as increased exposure to possible theft, vandalism, late pays, evictions, just disruptions in my possible rental income stream, versus subject B, which I feel that if a properly vetted tenant placed into this neighborhood and these attributes is going to stay there longer, have less payment issues, less susceptibility to all those other negative attributes. Ask them, get their opinion, get their feedback. So it's not saying that it's a slam dunk you should go with B or you should go with A. What we're trying to do is provide greater information that's quickly applicable to get you to the next step to make the best decision. All right, so now let's take it even a step further and say, okay, now I want to invest outside of my backyard. So a lot of the best investment opportunities across the country do not reside in the city in which you live in. I think I generally, I would say we get 95% agreement when we poll people and we say, do you think that your city has the best investment opportunities across the entire country, or do you think that there's other markets that are more advantageous at this time? Usually, most people are in agreement that there could be or possibly are better investment opportunities somewhere else out in the U.S. And that's why so many investors are going outside their own backyards to make these investments and decisions. So how do you evaluate properties when you don't even live in these cities? So challenge number 4, a cross-market challenge. Again, we have subject property A in Charlotte, North Carolina, single family, 3, 2.5, selling for $80,000, rents for $900. We get a GRM. Now we take a Kansas City property, 4.3, sales price $74,900, rents for $1,150. You get the GRM of 5.42. Let's put them side by side. We got a Charlotte property, a Kansas City property. Let's say generally comparable in size. Looks like Kansas City's a little bit bigger and a little bit cheaper, and the rent's a little bit higher. So when I look at this overall, this Kansas City property looks to be the better investment. It's lower cost. It's renting for more. It's a little bit bigger. GRM's a little bit lower. Lower is actually better on the GRM, not to be confusing. But so this Kansas City property looks to be the best. Let's pull our risk attributes, which is, RentFax provides this information nationwide, and let's see what it says. Well, so we pull them both. Subject A in Charlotte scores a 37. Subject B in Kansas City scores a 38. So what did this tell us, or what does this do for us? Well, number one, I want to highlight something, that when you use RentFax, we will provide 2 scores to you. The first score is a score that is based on the metropolitan area, and the second score is a score based on the USA. So what the difference between the 2 scores is, the first score is we're comparing your property against all the properties within the city you're looking at. So if we're looking at Kansas City, we're comparing one property against all the properties in Kansas City. In this particular example of the score, we use the national score, the USA score. What this is doing is comparing your property to all the other properties in the country. So when we compare 2 properties, Charlotte and Kansas City, we'll use this national score because we're using the same measuring stick. And in this particular example, they both scored about the same. So what does that tell us? From a risk perspective, they share a common risk profile. What that then tells me as an investor is I can use these kind of high-level revenue numbers, costs and profit numbers to make my decision. In this particular case, the Kansas City subject property would hold the edge over the Charlotte property. So this is, again, this took us a matter of minutes to reach these conclusions. It doesn't mean that there isn't further due diligence or you don't dive into it a little bit more, but just how quickly we can sort and filter and optimize our investment activities using data-based tools. So that's our fourth and final kind of subject for, well, we got one more. Property managers, can't leave them out. So this was challenge number 5, and it was a property manager that was looking to build door count. And so what they ended up doing to take on door count is, instead of organically kind of growing their door count, if you will, they took over a portfolio. So when you take over a portfolio as a property manager, a lot of times you inherit the poor practices of either a investor and how they place their tenants, or another property manager. There's a likelihood for it. So in this particular portfolio that they took on 33 doors. Of the 33 doors, 10 of those ended up in evictions. So just about a third of this entire portfolio, once they took it on, ended up in evictions. Of the evictions, of the locations where an eviction occurred, 90% of them scored 30 or below. 30 or below. So a third of this inherited portfolio went into, not foreclosure, went into eviction. When we looked at, segmenting that portfolio, let's look at just those 10 that went to eviction. When we scored those 10, 9 of the 10 scored 30 or below. So I think, in recap, what we were trying to present in these case studies, no matter how you touch rental properties, whether you're an insurer, an investor, a lender, a note buyer, a property manager, if you touch investment property, understanding the risk associated with that location can greatly benefit you in modifying and adjusting your business decisions. So that doesn't have to be a complex undertaking. And so using the resources that RentFax provides, the products we're providing, is what we're trying to do is simplify all this data aggregation and stuff that's influencing what everyone knows influences the performance of properties in these areas, simplifying that to a point where people can adjust their business practices, adjust their decisions, and just make better informed decisions using this data and not any subjective or personal bias influence. So with all that being said, I'll turn it back over to Stephen and see if I can field any questions, or if people have questions about any specific case study.
Fantastic. Thank you, Shane. We do have a question here. It says, do you provide maps so that if I am looking to buy in a city, I can see where all areas above a certain risk number are?
Great question, and we do. Let me try to pull up a map if I can real quick. Just bear with me a little bit. I think it would be helpful for people to see it. Let me make sure I can get there before I make any promises. Okay, let's see here. Let's pull this onto the screen here. Okay, so here is when you log into RentFax, you create an account and you'll get your login, and you come in and log in. Up here, there's two categories. There's reports and maps. When you click on the maps, after you run a location in a MSA, it will pin that location and draw the boundary and show the score. So here's an example of we ran this location in Columbus, Ohio, and we have the two scores. If I want to understand or learn about adjoining properties, I can just click on a location, just get a random address, and then run that report for that area. And what it will do is it will start to build a customized heat map for you for the city you're looking at. If you have 10 properties that you're running and you run them all and you get all the reports, when you come to maps, it will have this heat map start to be built out. So yes, we do have maps, a highly effective way to use the risk score, because adjacent boundary neighborhoods influence your neighborhood. So if I had a property, I'll just zoom in here. Let's say that I had like a property that's right on this street here, and this neighborhood was really bad, had bad attributes, negative attributes. I would know very well that even though my property was in this neighborhood with these attributes, that the influence from this one would come across, or my property would be exposed to that. That's why maps are a very powerful way to implement the risk score. But the risk score on itself and in itself, really just stands on its own. So if your property's in here and you're just surrounded by like neighborhoods or slightly varying ones, you're in good shape. So great question, and hopefully showing this map helped people.
Awesome. One more question. It says, let's see here. One moment. Which reports show the map details with the risk score, and how much do they cost?
Okay, so when you come to reports, any report that you pick, whether it's the risk summary or risk detail, or our packages, it will generate that and pin that on the map. So again, risk summary report, risk detail report, the rent package, and all our real results packages will create, pin the property address you put in here on the map, in addition to getting the report. So we get the report and the map by doing that. Now, how much a report costs, I'm going to take us out to the main website here. And because our pricing is based on two things, really. It's based on product and it's based on quantity. So the more data and information that you are getting through our products, the more credits it requires. So if you just want a risk summary report, it's 2 credits. If you wanted our most extensive product, it would be 8 credits. The price per credit goes down the more you purchase. Now, credits are good for a full year, so if you really gauge your investment activity or how you go through it to how many credits you're going to buy. But let's say that you're going to, I would say a typical investor, gosh, I don't want to say, I may not be typical. Back when I was investing, I would probably investigate anywhere from 10 to 20 properties before I moved forward on one. So let's say 10 to 20 properties. You're gonna need probably 50, well over 100 credits. So that report, just to learn that risk and a summarized single score, is going to cost you about $4, a little under $5. But what it did for me is once I got these scores and I learned about it, and then I got my mapping going, what it did is I became a highly effective investor. So I was spending my time aggressively pursuing the really good deals and not wasting my time with the deals I knew just weren't worth it or didn't fit my risk profile. So hopefully that answers that question, Stephen. You got any more?
Yep, one more. How do I present my report in such a way that I can give it to my superiors?
Great question. Let's see if I can get back to this. I'm going to just pull up a risk report here. So when you click on a risk report, you're going to obviously see it on the screen, and this is some of the, I don't want to get too off track here, but you can scroll through and start to see all the data and information. When you go, there's a view, print, PDF. If you click that button up there, what it's going to do is it's going to take what we provide online and it's going to put it into a PDF version. From here, you can save it and email it to someone, provide it to others. We even actually have the opportunity to brand these reports. If you're a property manager, if you're a realtor, whatever you're using, there's ability to brand these reports to show, present this data. Again, you can rest assured that the information you're presenting is 100% data driven. So we are aggregating data, presenting that. So it's a very informative and value add proposition that you can pass along to your clients as well. So.
Awesome. Another question. Is there data that indicates the advantages of buying properties with risk numbers greater than something other than 30?
Yeah, so that is a great question, and let me try to answer that. Is that I know personally investors that are highly successful in investing in properties that score below 30. Okay? The way they're highly successful is they know what they're getting into. So their practices, their strategies, their partnerships, everything they do is built and oriented around the effective acquisition, rehab, tenanting, and management of let's just say, of a higher risk rental properties. And they just have the fine-tuned machine. That's all they do. I have other investors that won't purchase anything in a risk score less than 60 or 70. And I call those folks on my tax write-off like investors. Because when you go up in score, as we move up in score into these areas, you can imagine what kind of neighborhood this is. It's very nice neighborhoods. And what happens in very nice neighborhoods? Prices go up, but rents don't necessarily go right along with it. So what happens is the financial, like if I use the term cap rate, if I don't want to throw too much jargon around, but your return on investment or your expected return as you increase, as you decrease risk or increase in this stability goes down. That means you may be perfectly fine taking a 4% return on investment because largely you're saying, look, I don't want to deal with evictions, I don't want to deal with late pays, and yeah, it is a tax write-off for me. I'm going to deduct my mortgage interest, I'm going to deduct my depreciation, and then I'm going to realize appreciation through the years because it's a long-term hold. So I want to come back to the question that it really, you can invest successfully in any score on this spectrum. And so as a property owner or whatever else, what we're trying to bring to light and to simplify for our audience and our users is how to choreograph everything around that location. That's what leads to the success of knowing exactly what you're getting into. So if you buy 30 and less, you know what you're getting into. Be prepared for it. You better have the confidence that you can operate within that level of risk. If I'm an out-of-area investor and I'm relying on professional property management to manage my property and manage my risks, do I really want to put them up to the task or the challenge of buying in these areas? If I am, I better vet them for that. Versus if I'm out of area, I may say, look, I'm going to have my properties professionally managed and they have a certain skill set and a certain level of which they successfully manage and buy within that range. Here's a great question. If you're going to buy a property and you have a property manager that you use and like, ask them. Go tell them, where are you most successful in managing? And if they don't give you geographic boundaries, have them give you property addresses. Just say, give me the addresses that you feel that you have successfully managed and are doing a great job at. Score them. Now you know the competency of your property manager. You may come across a manager that is between 40 and 60. They are doing a great job. Then you know where the neighborhoods you need to be buying if that is your if that's who you plan on using to manage your property. So, awesome. It's a great question. It's hard for me to give a direct and specific answer, but it really, you can be successful anywhere in this spectrum. It really becomes a customized response based upon who you are, what you're doing, and what your risk profile or risk thresholds are. So, Stephen, I hope that helped that audience member. It's a great question, but sometimes a tough one to give a concise answer to.
Gotcha. Thank you very much, Shane. Do appreciate it. Well, it looks like that is all the questions that we have for today. In fact, our the person who just asked that question just said thank you. So that's definitely a great sign. So thank you, Shane, for that. So yeah, looks like that's all the questions we have for today. We definitely appreciate everyone coming on board and taking your valuable time today and giving it to us. Shane, do you have any last words?
No, I don't. I just, I always like to thank people for their time to come out and to spend time to get, learn more about RentFax and how it can benefit them. And as always, if you ever have any questions or more specific detailed stuff to your circumstances, we always are trying to help our clients get specific answers to their situations. Don't hesitate to reach out to us. That's really, along with the product and the reports reports and the tools. We're here to help you be more successful in whatever you do.
Fantastic. And if you do have any questions, please email us at support@rentfaxpro.com. Again, that is support@rentfaxpro.com, and we'd be happy to answer any questions that you may have. And of course, please join us on our next webinar, and feel free to sign up for it at rentfaxpro.com/webinar. Again, that is rentfaxpro/webinar. Well, again, thank you all very much for your time, and until we meet again, take care. Bye-bye.